2.5%. Emerging market economies are facing generally higher inflation dynamics, due in part to exchange rate reactions to expectations of Fed tapering. Inflation pressures have prompted monetary policy responses in a number of countries, including Brazil, India, and Indonesia, who have all raised rates. Speculation regarding tapering has been the main driver of the Rand exchange rate volatility since the previous meeting of the MPC. The Rand appreciated to around 9.55 against the US dollar following the September decision by the Fed to delay tapering, and then reached a level of around 10 Rand 45 following the November FOMC meeting, when market expectations were for an earlier start to tapering. More recently, the Rand has appreciated somewhat as the expected timing was pushed back by the markets, and also in response to the SARS release of new trade data. The Rand has depreciated by 17% against the US dollar since the beginning of the year, and by 15% on a trade-weighted basis. The exchange rate of the Rand remains an increasingly upside risk to the inflation outlook, notwithstanding the relatively slow pass-through to consumer prices to date. The challenge facing the MPC is not only to anticipate the timing and speed of Fed tapering, but also to try to assess the extent to which tapering is already priced into the exchange rate. There is a risk that, should there be a stronger or more disorderly response by the markets to actual Fed tapering, the reaction of the exchange rate could be more extreme. These developments have been reflected in the non-resident activity in the domestic bond and equity markets. In September and October, when expectations of Fed tapering were modified, non-residents were net buyers of bonds to the value of 17 billion Rand, more or less reversing the net sales that followed the initial reaction in May. Since early November, however, when risk aversion returned, net sales of bonds have amounted to 9.7 billion Rand. At the same time, net sales of equities have amounted to 14.5 billion Rand. Year to date, non-resident purchases of bonds and equities have totaled 12.8 billion and 4.8 billion respectively. A further risk is the deficit on the current account of the balance of payments, which makes the exchange rate more sensitive to possible capital flow slowdowns or reversals. In the second quarter of 2013, the deficit amounted to 6.5% of GDP, and the published trade data suggests that a further deterioration of the trade account can be expected following the temporary collapse of motor vehicle exports and significantly higher imports in the third quarter. The actual outcome may be ameliorated to some extent by the recent inclusion by SARS of South Africa's merchandise trade data with its Southern African Customs Union partners in the trade statistics, made possible by the modernization of the customs data collection systems. The new inclusive data have resulted in a significant adjustment to the trade statistics published by SARS. However, in compiling the balance of payments accounts in the past, the bank made estimates of South Africa's trade with Botswana, Lesotho, Namibia, and Swaziland based on various sources. The historical trade data in the balance of payments accounts will be revised to account for the differences between the new data and our own previous estimates. These revisions will be published in the December quarterly bulletin on the 3rd of December and may also result in minor revisions to the GDP data. Nevertheless, the underlying trend of the current account is not expected to change significantly. The domestic economic growth outlook remains fragile. Following a rebound of growth to an annualized 3% in the second quarter of 2013, the third quarter outcome is expected to be significantly lower and more in line with the 0.9% recorded in the first quarter of this year. The bank's forecast for growth in 2013 has been revised down from 2% to 1.9%, while the forecast for 2014 and 2015 have been revised down to 3% and 3.4% respectively, from 3.3% and 3.6%. This is consistent with the bank's composite leading business cycle indicator, which continues to trend sideways, while the RMB-BER Business Confidence Index at 43 points was more or less unchanged in the fourth quarter, indicative of a subdued outlook. The adverse third quarter growth outcome is largely due to a quarter-on-quarter contraction of 2.1% in the manufacturing sector, in part a consequence of the protracted strikes that resulted in a 27.9% decline in the production of motor vehicles, parts, and accessories in that quarter. Reflecting these developments, the Kagiso PMI declined to 50 index points in September from 55.6 points in August, but recovered somewhat to 50.7 index points in October. Industrial action and safety-related stoppages also impacted negatively on mining output, but despite negative growth in August and September, a positive quarter-to-quarter growth rate of 1.4% was recorded. Encouragingly, the construction sector is showing signs of recovery with a generally steady upward trend in the value of real building plans passed, and the confidence of building contractors in the Business Confidence Index increasing to its highest level in almost 6 years. The moderating trend in the growth of consumption expenditure by households that has been evident for some time appears to have continued into the third quarter. Retail trade sales recorded a quarter-to-quarter increase of only 0.4% in that quarter and a month-on-month contraction of 0.7% in September, although wholesale trade was more robust. This is consistent with the FNB-BR Consumer Confidence Index, which had reached a 10-year low in the third quarter of 2013, with only a marginal improvement in the fourth quarter. The trends in credit extension are likely to constrain consumption expenditure in the short run, in the short to medium term. 12-month growth in total loans and advances measured 8.4% in September, down from 9% in August, while the quarterly growth rate was 5.3% in the third quarter. There are clear indications of a sharp decline in lending to households. 12-month growth in general loans to households, mostly unsecured lending, declined to 14.2% in September, the lowest rate of growth since February 2010, while annualized growth over 3 months was 2.8%. In August and September, contraction was recorded in this category. Growth in mortgage lending, at below 3%, remained subdued despite a small acceleration in September, mainly driven by commercial mortgages. By contrast, installment sale credit remained buoyant, while 12-month growth in total loans and advances to companies increased by 10.6%. Household consumption expenditure is, however, expected to be supported to some extent by wage trends. According to Andrew Levy Employment Publications, the overall average wage settlement rate in collective bargaining agreements was 7.9% in the first 9 months of 2013, compared with 7.6% for 2012 as a whole. Although a number of these settlements are generally well below the initial demands, they are considerably above the upper band of the inflation target and pose a potential risk to the inflation outlook. According to the quarterly labour force survey of Statistics South Africa, the official unemployment rate moderated to 24.7% in the third quarter of 2013 from 25.5% a year earlier. This follows an increase in employment of 2.8% or 383,000 jobs over that period. This implies that the economy has only now returned to the same levels of employment attained before the crisis. These figures, however, are in contrast to the quarterly employment statistics of Stats SA, which showed a 0.1% growth in the formal non-agricultural sector from June 2012 to June 2013, and which correlates more closely with GDP trends. Fiscal policy, as outlined in the medium-term budget policy statement, continues to be counter-cyclical, attempting to balance the need to support the economy and the need for fiscal consolidation. A deficit of 4.2% is projected for the current fiscal year and is expected to narrow to 3% by 2015-16. Non-interest real expenditure growth is capped at an average of 2.2% over the next 3 years, and the 3-year agreement with civil service unions, due to expire in 2015, is expected to limit the growth in the public sector wage bill. This pace of consolidation should stabilize the net national debt at 44% in 2017-2018. Food price inflation moderated to 4.2% in October from 6% in September, with a deceleration in price increases being broad-based. Final manufactured producer price inflation declined from 7.5% from the 7.5% peak in July to 6.8% in September. Agricultural product prices increased by 4.3% at the producer price level in September, with cereals and other crop prices declining by 6.8%. This was in line with lower international food commodity prices, which offset the impact of the weaker exchange rate to some extent. While food price inflation may continue to moderate in the short term, upside pressures can be expected from the exchange rate and the fact that meat price declines, due in part by drought-induced culling, are unlikely to persist. International oil prices have remained relatively contained below the $110 per barrel level since the previous MPC meeting. These prices continue to be dominated by political developments in the Middle East and the global growth outlook. Should international oil prices and the exchange rate remain at current levels, a small increase in the domestic petrol price is likely in December, following a cumulative 48 cents decrease in October and November. It is important to note, however, that further weakness in the exchange rate will pass through quickly into these prices. Despite the better-than-expected October inflation outcome, the MPC continues to assess the risks to the inflation outlook to be on the upside, mainly as a result of further potential exchange rate pressures. Tapering by the Fed is inevitable, but until a decision is taken, financial markets globally are likely to experience heightened volatility. There is a high degree of uncertainty regarding the extent to which U.S. policy actions are already priced into the exchange rate. Compounding the risks to the exchange rate is the stubbornly wide current account deficit, notwithstanding recent revisions to the trade data. The deficit increases South Africa's sensitivity to global spillover effects. The MPC is mindful of the adjustment lags and will be watching carefully for signs of a positive current account response. We need to take advantage of the depreciated exchange rate and not allow the benefits to be eroded through higher wage and other input prices. Action will be required should the adjustment mechanism not operate effectively. While the exchange rate impact on CPI is increasingly evident in the core inflation measure, to date the pass-through has been relatively muted. But this is unlikely to persist should there be a significant further depreciation. At the same time, the policy dilemma is underlined by the deterioration in the growth outlook. The committee assesses the risks to be on the downside amid continued supply disruptions and low business and consumer confidence. The downward trend of household consumption expenditure is indicative of relatively weak demand conditions in the economy, and slower bank credit extension to households is likely to reinforce this trend. The inflation forecast remains uncomfortably close to the upper level of the inflation target range, but our central forecast remains within the target. Given the increased upside risks to the outlook, we do not see room for further monetary accommodation. We will continue to monitor developments carefully on an ongoing basis and remain committed to act as required. The MPC has decided to keep the repo rate unchanged at 5% per annum at this stage. Thank you. Happy to take any questions that may arise, and obviously, as is our custom, my colleagues, members of the MPC, will also answer questions. Anyone? Franz, please again just identify yourself.
Sorry. Franz Wild from Bloomberg. Maybe we should just get the usual question out of the way, whether the decision was unanimous and if either a hike or cut was discussed. And I have a second question.
Let me deal with that one first. We'll come to
sure.
the second one. I should have just spoken to that one straight off. I think certainly the decision was unanimous, so there was no ambiguity about the question of holding. The question of whether there was room to reduce rates was discussed, and as we've indicated, the view of the committee is that we don't see that that room exists. Discussion about increasing rates consumes a considerable amount of time, with really the question being the circumstances that would warrant a rate hike, and if so, in what time frame would that occur? We didn't have agreement on the time frame except that it wasn't at this meeting. We all were agreed that there wasn't room for, we did not think it was appropriate to raise rates at this meeting, but it was certainly a topic for discussion, and among everybody was a question that we need to consider if and when, and given what we've said in the statement, what implications that would be. So it is an uncertain environment, as we've said. We don't know how much is priced into the Fed tapering. We don't know its timing. We don't know its quantum, and we don't know what its impact would be on the depreciation of the currency. But we are concerned at where that impact and its pass-through to inflation, as well as a number of other factors as we've outlined in the statement. So certainly raising rates was a discussion. Yes, sir.
Pat McGrory from the Wall Street Journal. Is there anything else that monetary policy can do to help address this bind between falling growth and rising inflation? And you've spoken many times in the past about the need for policymakers for over a year now to sort of address the challenges that South Africa's economy faces. Are they doing enough, and are they speaking closely enough along the same lines to address South Africa's growth challenges?
Well, I think we need to recognize that quite a number of these issues are structural and they need to be addressed. Certainly there we would reiterate the point that as a country, and I want to emphasize that question, it's all players in the country. It's not about pointing a finger at government. It is about a coherence of policy and action between business, labor, government, working together with a very clear approach of what we need to do. We've indicated in our statement that one of the impacts on the current account has been a decline in exports that arose out of the falling export of motor vehicles, and that related to action that was taken. So you can do something about it. And I think that that's the challenge between all of us, is to recognize that the climate is extremely difficult and we need to work together to find the responses. And I think there's a lot of, it's a much more positive environment in terms of the interactions between the different players. But the environment is not getting better in terms of either global or domestic. It is very risk-prone, and we need to appreciate all of that and look at what we can do. So there's always room to do more, but I want to again emphasize that it's a responsibility of all the role players. Yep.
Governor, a question via the webcast from Peter Worthington. What exchange rate pass-through coefficient was used in the SABC inflation forecasts for 2014 and 2015? Thank you.
Rashad, do you want to deal with that?
Thank you, Peter. Look, the SARS, the SARB model has an exchange rate pass-through of 0.2 or 20%. I think what's important is that when we make judgments about upside or downside risk to inflation, we take into consideration the variance of this coefficient at times of booms or times of recession. But the model has a pass-through of 20%. Thank you.
Hi, afternoon, Governor. It's Ntakiso from Business Day. Just one quick question on economic growth. If, say, for instance, this year and into next year, it disappoints more than expected, would the door for rate cuts be open again? Thanks.
I think that it's, again, the question of cutting or raising is not simply about one element. Obviously, what's happening with growth is of great concern to us. Not simply because of what it enables if you have growth in terms of your jobs and in terms of everything else. So it is something that we would certainly consider. But it depends what else is happening. It's not one factor. Obviously, our own approach is very data dependent, and our ability to see through what is happening. And if the situation changes, if data changes, if the circumstance changes, then of course we would relook at it. So this isn't saying that this is a position that holds for time immemorial. It does depend on what is happening and what we take into account. What we're saying is that this moment in time, with these conditions, we do not see room for a reduction in rates. Frans?
Governor, you did touch on this earlier, but I wonder if you could elaborate a bit. Last time you did talk about exploring possibility of a hike, especially given the latest CPI data. Can you elaborate on what exactly that means?
I'm not quite sure whether you're referring to this meeting or the previous meeting, because you said we explored at a previous meeting the question of a rate hike. Just can you clarify?
I think at the last meeting you said there is room to explore in the future. So if you could elaborate on what this exploration is exactly, and what exactly that means.
It took us 2.5 days. Perhaps somebody would like to just talk to that question of the factors that come into to the considerations of a hike. I thought I'd put that up, but perhaps somebody would like to add. Who? Anyone? Going? Don't point at each other, one of you. Kuban, you look the most reluctant. Go.
Thank you, Governor. At every meeting there's a discussion of the three possible options of a decision, the cut, a hike, or hold. And at every meeting the data is looked at and the trends explored. So certainly at this meeting, as the Governor pointed out, there was a discussion about a hike. And certainly some of the data would be indicative of a hike given the fact that there are inflationary pressures. On balance, however, the committee was of the view that we would hold rates. However, we will continue to review both the data and other economic developments going forward. So, I'm not too sure what further elaboration on a hike could come in. The SAB's mandate is to target inflation. And if we think that inflation is rising and inflation expectations are being unhinged, we certainly would have no hesitation to hike rates.
Does anyone want to add? Yeah?
Governor, a question from Garrett Brickman. Recently, the ECB has confirmed that it is considering releasing minutes from the meeting of its governing council. This would bring the ECB in line with the public relations policies of other three major central banks, as well as many EM central banks. Has there been any renewed consideration within the SAB as to whether the MPC would itself release minutes of its meeting? Thank you.
No, I mean, it has come up on a periodic basis. There's been no rediscussion of that from ourselves. We are quite unanimous on a view that we don't want to release the minutes. And again, I would reiterate the issues. I'm quite sure that whoever is releasing minutes, these are edited minutes that somebody has taken and you release to the public. It comes out sometime after the meetings. Our view is that the discussions that we have should be full, frank, and nobody playing to any gallery. So that part of the question is to ensure that we all feel comfortable expressing our views with the ability to listen to each other and change our minds. If we raise a question, you're able to consider, to discuss, to explore the issues, and be able to say, that was my thinking, but I actually have been influenced by what I'm seeing, what the data says, how somebody else has maybe interpreted that data. And we think that is an important question around the integrity of our own discussions. We come here to you immediately after the meeting. Well, more or less immediately. We finish 12 or 1 o'clock, and you're here at 3 o'clock. And we tell you what our thinking was. So in essence, we've told you what we've taken into account, how we've understood it, and we think that the direct access by yourselves as journalists or for dial-in or anything gives you the questions to us about anything you wish to raise. And therefore, we feel that we are very transparent in our approach, and that it enables us to have the kinds of discussions we want to have, and to ensure that we fully disclose to you what we took into account, which is what minutes would do, and we do it immediately. So we don't reconsider, we haven't reconsidered the question of whether we should publish minutes, because we think we are transparent in the way we deal with things. Thank you. Other questions? Anyone else? No, another question from you. Please go ahead.
Governor, question from Peter Montalto.
Hi, Peter. We were waiting for that. We thought we couldn't have a meeting without you calling in. Welcome.
The challenge for the SAB may well be increasing with the Fed taper soon, but also ECB increasingly signaling further loosening may occur. How do you balance the conflicting risks and signals from these two central banks on South Africa, both in terms of currency risks as well as growth or inflation? Thank you.
We learn to walk a tightrope, and we hope that there's a safety net underneath. We certainly would look at it in those terms because, and this is part of the challenge that you have, is that there are very different conditions prevailing. If we take the United States, which obviously is impacting globally on its decisions and when it will taper, we know it's going to come, and what is built in, as we've outlined, which has particular challenges. Our concern equally, I mean, the plus about the tapering, let's just spend a second on that. The plus about the tapering is that if the Fed is in a position to commence with tapering, it means the US is getting better. That's got to be good for the world and the world's economy in the medium to long term. Will it be a bumpy ride getting there? Absolutely. But it means that things are beginning to normalize, which is what the world's economy needs after the global crisis, which is still continuing and mutating. If you look at the ECB, and we've indicated that, the ECB is having a very difficult challenge because the Eurozone is growing very slowly. There's risks of deflation in a number of the countries, and it has different challenges. Now, obviously, as far as we're concerned, there's different relationships. If you look at the UK seems to be doing much better. Its growth is picking up. The UK is a very major partner for South Africa, both for investment and for exports. So there's different issues that we have to take account of, and we think that in balancing all of them, we've tried to do that in the decision and the thinking. So yes, we have to think about each one and what its implications are. And we would hope that the space created by the ECB for the Eurozone to get a better traction going and get some growth and to resolve some of these issues is very important, not only for ourselves and other emerging markets, but for coming out of this very, very deep financial crisis that we've had. Should things normalize or begin to normalize, we've still got a very long way to go in the European Union to get back to some normality, some growth, some positives. So it's looking slightly better, but I think with a lot of risks, and that's what we have to balance between each of them. I don't know if anyone would like to add. But that's precisely the challenge for all emerging markets at this point in time. You've got, as you said, a multi-speed recovery, and some of it's sort of not really recovering. I mean, it's stumbling along. So very big challenges globally. Frans.
Governor, you say that the risks to inflation remain on the upside, yet the actual forecasts are slightly better. How do you reconcile your hawkish tone with the forecasts?
Well, the forecasts indicate what we're looking at, but we talk different between the forecast and the risks. If you look at it, what is a serious risk is a further depreciation of the currency, and if that was to feed through, then it's going to actually impact. So your forecast is looking at what we're able to forecast and estimate, but the risk is about the depreciation and a significant depreciation, and if that feeds through. So there is a difference between what exists as our forecast for inflation and the potential addition to that by the instability that may arise through a depreciation. And again, as we said, if it's a significant depreciation, it's how far it goes, how long does it stay out of, or at the levels that have been increased. And you see, and as you know, the rand is very volatile. So it's two different things that you're looking at in a way. Anyone like to add anything? Anyone else? If not, thank you all very much for being here. I wish you well for your Christmas holidays when you get them. Drive carefully. You have the dates for next year, yes? We will put them on our website just to ensure that they're already on the website, but when we put this statement on the website, we'll add the dates just again so that you're aware, so that you have the dates for next year, and we wish you all the best, and let us all have a risk-free year end and come with a better outlook for 2014 than is evident at the moment. Thank you all very much. Thanks, colleagues.